Welcome back to the Milwaukee Real Estate Market Update. We're covering what happened in November 2022 and how it impacts your real estate decisions. This month inflation came in better than expected, but it's still running high. This is definitely going to impact your mortgage rate, and we're going to talk more about that here in a bit. I'm here to give you the info you need to make the right decisions regarding your real estate. Should I buy a home? Should I be selling? Is the housing market about to crash? If you're new to the channel or returning because you watched a previous video and found some value, it would mean the world to me if you took a second to subscribe and also hit that bell icon so you get a notification anytime we post a new video just like this. I'm Ty Ash with Houseworks Collective and Compass, your local real estate expert, and let's dive into the current events and how that might impact us here in the Milwaukee area. Starting with our national housing numbers according to Fred. 751,000 homes for sale versus 753,000 homes last month. So really no change month over month. Actually, that's a little bit lower than normal changes due to seasonality during the holiday season. Let's compare that 751,000 homes available for sale versus 511,000 back in November of last year, or up 47%. That number might seem super high, and it's definitely a big increase from last year, but that's because we had an abnormally low baseline number. For some historical context, we're still down right around 35% in inventory compared to November of 2019. 2019 was really that last time that housing was functioning normally, meaning months of supply was near 4 months, and affordability was much stronger with rates around 5%. As I've highlighted before, it's a different story here in our Milwaukee market. Active listings are down 19% to last year. Take a look at this Redfin year-over-year chart that actually shows the Milwaukee Metro active listings and the change of percent over time. So two different charts, top and bottom. The black line on the top here is our 2022 inventory, and you can see it's running way below the last 3 years, every single year. The bottom half of this chart is also showing that we're seeing some of the biggest declines as a percent in our active inventory as well. Why is this? It's the new listings. On a unit basis, we continue to run lower than the last 3 years. You'll actually note that new listings were also dropping considerably in November through December of 2019, leading up to the pandemic, and that here is the blue line. We actually were starting to see some significant drops in our new listing activity and an accelerating housing market going into COVID, and essentially what we went into with COVID was like putting gasoline on a fire and really made it take off. We'll talk all about this in just a moment of why that's a problem for people looking to buy here in Milwaukee in 2023. Moving on, last month I did a deeper dive on foreclosures and why I don't believe that's really going to play a significant factor in our 2023 inventory levels. This month's update is just first a refresher on the chart from last month, which we'll pull up here, showing where we left off on foreclosures last year in Q3, October 2021. And you can see here, significantly down from pre-pandemic levels, very low numbers. Second, I'm going to pull up just a quick screenshot of a recent article shared by the exact same company showing this data with an awesome clickbait title that's essentially showing something that somebody's going to look at and maybe use that as information to say how foreclosures are booming, right? In this article right here, we've got up annual 64% increase in November for foreclosures. But you read down one paragraph and what you find is this quote: while foreclosure starts and foreclosure completions both increased compared to last year's artificially low levels, they declined from last month. And lenders often put a moratorium on foreclosures during the holiday season. Many of these foreclosures that are being completed today are really just being pushed out and restarted back from 2020 pre-pandemic timeframe. And we're still at these historically low levels of new foreclosure starts, primarily because homeowners are sitting in a good position with lots of equity. And many people are not going to sell their home or go into foreclosure when they know they've got equity in it. They'll just put it on the market, sell it, and take home their returns. Next on our list is inflation. So more good news based on inflation coming in lower than the expectations for the second consecutive month. This data is from the U.S. Bureau of Labor Statistics. The U.S. consumer prices climbed 7.1% in November versus a year prior. The biggest percent change versus a year ago continues to be energy at up 13% to last year, but we're also still seeing higher year-over-year increases in food prices, as well as the all other items, which includes items you purchase and services that you use every single day. Think shopping and shelter, which this is considered, this last bucket here, to be core inflation because food and energy is typically more volatile, especially in today's environment where we have a little bit of war going on and some restricted access to supply. A deeper dive on these major categories: food prices increased 10% over last year, driven by the food at home bucket, which typically has a correlation with gas or transportation costs. Energy increased 13% versus last year, driven by both commodities like oil and gas, as well as energy services like electricity and the gas you have hooked up at your house. And finally, core inflation rose 6% versus last year, driven by the things that you buy every day and the services you use, like new cars, the shelter that you rent from. Shelter, as you dig under the covers here a little bit, is sitting at about 7%, right in line with our total inflation number. One note is that the shelter percent change may be right around this average, but it makes up a significant portion, right about a third of the total CPI basket. It's very likely that this is going to continue to drive inflation, even though we're seeing some good positive momentum, but it could be sticky because leasing, the apartments for rent kind of stuff, that's done in 12-month increments. So it might take a while for this number to come down. Why do I bring up inflation other than, it's just what everybody's talking about? Well, inflation and everything going on right there does impact your mortgage rates. As a result of this good news on inflation, specifically that it came down lower than expectations, you'll see a positive reaction from the market. Improving inflation numbers is an indicator to the Fed, who sets interest rates that banks lend at, that they can slow down their rate hikes. And that's exactly what happened yesterday. Inflation came in better than expected on December 12th, and the Fed announced a 50 basis point rate hike on December 13th. And the market sees this all as a positive. To put it simply, mortgage lenders see less risk in lending to homeowners, which lowers the rate that you receive for your mortgage. As of Wednesday, December 14th, from Mortgage News Daily, we can see that rates are landing right around 6.27%, down almost 1/3% from the middle of last month, the last time that we provided an update. Interest rates on average a year ago were 3.1% though, so that's why we're seeing some of this declining sales data for homes, is the affordability issue of having rates still being pretty much twice as high as they were a year ago. As always though, I want to highlight the relationship between mortgage rates and the 10-year US Treasury bond, and why we're still seeing rates lower in the exact same month that the Fed is raising interest rates. So here are the 10-year Treasury and the average 30-year average mortgage rates on one chart. To start 2022, the spread was about 1.3% between these two numbers, 1.76 for the 10-year Treasury and a 3.12 for mortgage rates. Now, with the large spike in volatility that we're seeing in the market, our spread is now at 2.44%. So 1.3 versus a 2.4, there's almost a 1 percentage point spread versus what is typical to see between mortgage rates and the 10-year Treasury. So why are these related is a 10-year bond from the US government has always been seen as essentially the safest investment you can make. And because of this, the rate of return of a riskier investment like a mortgage-backed security, which is just a bunch of mortgages put together, is heavily correlated because the spread between that, there's a little bit more risk to lending to an individual homeowner as opposed to lending to the United States government, who's never defaulted on a loan. If the spread was more normalized, we would actually see rates could be in the low 5% instead of the low 6%. This is something that could change very quickly and something to keep an eye on because it really could cause a surge in buyer demand, pre-approvals, and everything like that. Now, let's just definitely, highlight here, 6 to 7% rates are truly an outlier in the last 10 years. And It's a good thing we weren't back in the 80s, high teens, not great. Ask your mom and dad about that. But another thing to know as we're talking about what's going to happen to rates next is if you look at this mortgage rate chart, at each gray shaded area, that indicates where we were in recession. Okay, at nearly every recession, we've seen the rates come down. And let me walk you through exactly kind of how this could play out. We're expecting that there could be we're either in recession now or there will be a recession next year. And when things in the economy aren't going well, people seek safe investments like a US Treasury bond. Well, if there's more people that are demanding it, they then don't have to give as high of a return on that investment that the investors are making, which will actually start pushing those prices down. That's how the mortgage rates start dropping when we go into a recessionary environment, which is being caused by the Fed rate hikes. They're not letting banks lend money at a lower rate that allows businesses to produce more economic output. So what is the Fed really trying to do? Well, they're trying to cause a recession, which would lead to some higher unemployment numbers. Because you can't produce as much, because people aren't buying as much, they don't need as many employees or need to produce as much end goods. But what are we really looking at for unemployment right now is nationally, we're at about 3.7% unemployment, which is very strong. Here in Wisconsin at 3.3% unemployment. Many of the past three recessions, excluding the COVID recession, all started around a 4 to 5% unemployment rate. So that's going to be a leading indicator that the Fed can finally let up and ease up on these rate hikes and actually stop. As of now, they're really not signaling that they're going to slow this rate hikes until the end of 2023, almost till 2024, where they might actually decide to lower rates again and start stimulating the economy again. So we'll take a quick pause here. Lots of information about the national headlines and how they might relate here to us here in Wisconsin, Milwaukee specifically. What other national headlines are you looking for? Ask me in the comments below. I'd love to give my take on any current events that you're seeing out there or any sort of clickbait headlines. Now, let's dive into our local market here in Milwaukee, obtained through our local MLS data. In November 2022, residential homes here in the Greater Milwaukee Area sold listings 1,100 homes, down 33% to last year. Active listings 2,500 homes, down 19% to last year. This month, we saw the sold to active percent change relationship be negative again, same as last month. There was about a 14% spread between down 33% sales and the down 19% active listings. What we'll see here is that this will cause months of supply to grow versus a year ago. But note, in November, new listings fell 12% to last year. We're still not replacing inventory at a fast enough rate to give enough options to home buyers at the affordable prices that they need. However, this was an improvement in the new listing activity versus October, which was down 19%. So a little bit of positive momentum there. Big reason, most home buyers are home sellers themselves, so not as much inventory comes live on the market when that person has to be a buyer themselves in a competitive environment where there's some unaffordability. Months of supply, 2.2 months versus 1.8 months last year. This is normally a time of year where we actually see this metric grow. We see more months of supply available just because of the seasonality. But in general, we're seeing this increase because it was just so low a year ago. Again, healthy really starts at about 4 months of supply. So we're still sitting at about half as much as what we need. Median days on market, 22 days versus 24 days last year. So we're still seeing homes get accepted offers relatively more quickly than a year ago. And last, median sales price, $292,500, up 8% to last year, which was sitting at $270,000. Values are still increasing versus a year ago, even with the headwind of affordability, but the stronger tailwind bringing these values continuing to rise is extremely low inventory and not enough new inventory coming onto the market. And next up, our two-family or duplex inventory here in Milwaukee County. Sold listings, 140 properties, down 26% to last year. Active listings, 300 properties, down 53% to last year. So really big spread there in terms of the sales and inventory, just not enough active listings out there for the investors. New listings, 130 properties, down 35%. Again, seeing a lot of softness here in the new listing data. Not as desirable to list your property when you don't know if you'll be able to go find a better investment out on the market. Months of supply, 1.6 months versus 3.5 months last year, significantly down based on that relationship of sold to active listings. And then median days on market, 15 days versus 27 days last year. Properties getting accepted offers almost twice as fast as we were a year ago. Median sales price is sitting at $162,000, which is down 9% to last year. So a little bit different from what we're seeing in the single family space, where we're seeing prices continue to rise. However, it's very important to look under the covers at the data here and understand what's happening at the prices $180,000 and less versus the $180,000 and above. 54% of sales last month were in that $180,000 and less, and we're only down 19% in sold units versus a year ago, as opposed to now 46% of sales happened in that $180,000 and above, with sales being down 33% to last year. So usually we've seen this be a balance of about half of our inventory is above 180, half of it below. So this is a mix causing the price, if you're just looking at all the inventory, it looks like there's some significant decrease in value. After you go on the covers, that's not necessarily the case. It's just what's actually transacting. When there's not enough sales data, you'll see weird data lines like this. It's time to talk about what this means for the buyers. So here's a chart of our active inventory in the Milwaukee area, where we're sitting around 2,500 units. The most recent healthy functioning market was in 2019, where we had closer to 4,000 units, which you can see on this chart. With the slowdown in new listings, limited new home construction that we see here in our area relative to the national scene, and demographics such as the millennial home buyer, it's really hard to see this inventory improving in the future. And what does that mean? It's basic supply and demand. If you're waiting for price drops outside of the normal seasonal pricing fluctuations that we see from November to February, you might be waiting for a long time to really see that come to fruition. If you're waiting for interest rates to fall, then essentially we get down to that 5% environment. We've seen in past data lines that really stabilizes the housing market, and you're going to see a lot of buyers come back and have a more competitive environment, very similar to what we had in 2021. However, if you take action now, it's likely that you'll be able to take advantage of the imbalance that we're seeing between supply and demand, meaning you buy now. We're not really expecting more inventory to come. Low supply demand means it's very likely we continue to see prices either stick or increase over time, and that's good for you. You get the appreciation. And what you're holding out for is that refinance opportunity. Even if you buy at a 6.25% rate today, you could refinance in the next 6 months if rates get to 5%, when everyone else in the market is, all fighting over the same small amount of inventory, waiving inspection, waiving appraisal, all those crazy things that we saw in previous markets. If you need a way to kind of bridge the gap between making those payments today at the higher interest rate and today's prices, you're going to be waiting for the opportunity to refinance, but bide your time with a 2-1 buy down as a way to negotiate a better interest rate for the first 2 years. This is going to temporarily make your payments better, but definitely in today's market, don't discount the value of having your full inspection contingency without having to soften it up and say that you're not going to request something under a certain dollar amount. This was almost standard, and we saw a lot of waiving of contingencies in their entirety in 21 and 2022. Next up, sellers in Milwaukee. The market's definitely changed, mostly driven by the unaffordability that we're seeing based on these interest rates. We aren't seeing as much of the high bids going way above asking, but the best homes that are well marketed with good photography and are priced well based on the times and recent comps that we've had over the last 3 months, they're the ones that are going to continue to receive what we're still seeing, multiple offers, usually between 2 to 5, and get an accepted offer within the first week or so. These offers in some cases are still having the softened contingencies, but we're seeing less of the waiving of contingencies in their entirety, which is a good thing because you, the seller, is probably going to be a buyer yourself, and you just have to go right into that market yourself. One stat line that we always like to share: in the month of November, the closed transactions percent of ask price was sitting at 98.6%. In the hottest of times, we're sitting above 100%, but historically, this percentage has been much lower, as you can see on this report from our local MLS that dates all the way back to 2015. And last, typically, our home sellers are move-up buyers or downsizing buyers that are relocating based on personal or family reasons, as opposed to getting a great deal, making a financial decision. Usually the decision is, we had a kid, we need another bedroom, we gotta move. That's usually what we see happening. Now is still probably the best time that we've seen in the last 2.5 years, where you can still sell, and you're selling your home and getting a profit on it. And if you bought well before 2019, you'll probably have some significant wealth gains, on your property. But this is probably the best time you have to buy. Just kind of like what I just mentioned above, and my advice to the buyers is, we're seeing the lowest levels of competition from buyers that we've seen in a while, and you can use some strategies to buy some time for some refinance opportunities in the future. And you're probably going to be the most favorable financing person out there shopping right now because of your asset, the home that you currently own and are selling, meaning you're maybe putting a little bit more down. So sellers, don't delay. You might want to get your home listed on the market. Wait until, probably after the holidays, when people are going to start ramping up again. We might see an early spring season yet again. To wrap this all up, if you found value in the information that I just covered here in the Milwaukee area, please subscribe and hit that bell notification so you know when the next video comes out that's just like this, as well as any other content that we post on this channel. Also, please give us that thumbs up, hit the like button, let us know if you enjoyed listening to this, and if you want us to add any further details or headlines in the future. Thanks. I'll be back again next month with your local Milwaukee real estate market update.